Hello viewers, this is Dr. Alok Chajed welcoming you once again to Already Late, a channel that brings to you insights into the world of personal finance, investments and economy in the simplest manner. FANG, have you ever heard of this? Now FANG is an extremely popular acronym comprising of Facebook, Apple, Amazon, Netflix and Google, which is today, of course, the parent company is Alphabet. These companies have been the favorites of investors and traders in the United States. It is not that these are the only big names or good companies in the US, but having an acronym makes anything sound very cool, catchy, and of course it goes viral. There are the likes of Microsoft, Tesla, and many more great companies in the US. But FANG became extremely popular and has created a buzz about investing in US. Everybody wants to invest in US. In this video, I will take you through answers for some questions that you need to know if you are planning to invest in the United States of America. I will explain the rules, the way in which you can invest, the cost of investing, the tax treatment on any of your investments, and whether investing in US is right for you or not. How do you decide this? And trust me guys, all this without any complex terminology. Yep. So first let us see what are the rules related to investing in US. RBI, Reserve Bank of India, allows investment of up to 2.5 lakh US dollars every financial year by all resident individuals, including minors. All you need is PAN card, a proof of address, a proof of bank account, and of course, you need money to invest. The rules sound pretty simple, don't they? Yes, they are very simple and everything is automated. Now let's move to the next question. How can we invest? To invest in US stocks, you need to have an account with a broker, just like you do for all your Indian share trading. There are many Indian companies who have started offering services of investing in US in association with a foreign partner. For example, you can invest in US shares through HDFC Securities, who have tied up with Stockal and Drive Wealth. ICICI Securities and Axis Securities have tied up with Saxo Bank. You can also go through companies like Vested and Interactive Brokers who offer the same services. They are brokers directly with the SEC registered there, so they trade directly in the US markets. And Zerodha is also set to offer this facility very soon. Irrespective of who you choose, the process of transacting is pretty much the same. Every time you transfer some funds for buying shares, you need to fill a form called A2 form. This is a standard RBI guideline. The form is given by RBI, and all these companies will help you automated data capture. So you just have to give the amount, the form comes in, you need to sign, upload it back. Absolutely hassle free. So this is how you actually go ahead and invest. So having understood the rules and the operating procedure, let us now look at costs associated with investing in US shares. Now there are a few direct costs. I can put them in 4 categories. These are the 4 costs you need to know about. The first one is account opening fee. HDFC, ICICI, Axis, all these guys charge somewhere between 1,000 to 1,500 for opening the account. Vested charges 399 rupees for opening the account. Then the second category is transaction charges. These include brokerage and other charges. Now these start from as low as 1 cent or sometimes even free, and can go up to a couple of dollars and slightly more than that, depending on what plan and which service provider you choose. The third type of transaction is annual fees. It could be 0 or it could go up to 10,000 rupees, again depending on the type of plan you choose, depending on how much you want to invest. And the fourth and usually not very visible kind of charge is the currency conversion charge and the wire transfer, the fund transfer charges. Now remember, when you purchase shares in US, you have to purchase them in dollars. But when you transfer the funds, you transfer them in rupees. So rupees have to be converted in dollars. So each of the service provider will have a rate for that day. Now that could also be different across different service providers. And again, when you sell these shares and want the money back, you have to convert dollars into rupees. So there will be some charges there again. So these are the 4 different types of charges which are associated with investing in US. Having understood the costs associated, let us now move to taxation. First of all, you need to know that all taxes have to be paid in India only. You do not have to pay taxes in US. So that saves once again a lot of worry. Now you know there are 2 ways of earning when you invest in shares. It could be through dividends or it could be through capital appreciation. Dividends are taxed at a flat rate of 25%. Now for example, for every $1 of dividend that you receive or the company declares, you will have to pay 25 cents, which is 25% of $1 as tax. Capital gains are taxed in 2 ways. If you have purchased and sold the shares within 24 months, which is within 2 years, this will be treated as a short-term transaction, and any gain arising out of this transaction will have to be added to your taxable income in India, and you will be taxed according to the income tax slab. So it could be nil or it could be up to 30% plus surcharge. So wherever you are, you will be taxed accordingly. Now if you buy the share and you sell it after 2 years, the transaction is long-term in nature, and the capital gain that you will pay there will be 20% of the profit. However, you can use the benefit of indexation to adjust your purchase price according to the inflation. Now you can find an explanation on indexation in my video on debt funds, the link of which is now available on your screen. Now it leaves us with very important question, probably the most important question, whether you should invest in US stocks. A lot is being written about the performance of US stock markets in general, and there is a lot of talk about stocks giving over 400% to 600% returns in a matter of days. Now all this makes it too tempting for anyone to want to invest. Undoubtedly, US stock markets give you access to some of the best global companies, the likes of Alibaba. It also gives you an opportunity to invest in global leaders, because you know most of the global leaders are based out of US, be it Adobe, be it Xerox, or even Coca-Cola. Now this is the country where Amazon share price doubles in just 5 months and Tesla multiplies by 4 times in the same period. So we all need to be heading to NYSE and NASDAQ straight away, right? Now hold on just for a couple of minutes. You will not lose a lot. Just wait for me to complete my analysis. Now during the same 5-month period from March to August, which I have been talking about for Amazon and Tesla, there have been many stocks in India too which have given very similar returns. Reliance Industries has gone up by 2.5 times. Cipla, Britannia, they have doubled. Aurobindo Pharma has tripled. There are many other stocks which have similar numbers. Now, I am not a fan of talking about past performance because it kind of tempts you to go and invest without understanding a lot of things. I am mentioning them here only to show you a comparison that if you are looking at earning returns, Indian markets aren't far behind. Now, these were some specific stock examples which hog the limelight. Let me show you a comparison of the 2 indices, the 2 leading indices, Sensex from India and the Dow Jones Industrial Average from the United States. Now look at this graph. This comparison is again just to give you a clear picture of overall market performance. Now you see the 2 lines on the graph are not very divergent. You can just one look at the graph and you know in the long run your returns from US may not be too different from your returns from the Indian markets on a diversified scale. Of course, your returns from US stocks will be impacted by the rate of dollar when you purchase the share and the rate of dollar when you sell the share. Now this could add to or take away from your absolute returns on the dollar terms. Now, so the bottom line is, should you invest in US equities? Having US equities in your investments is not a necessity. But if you wish, you can add up to 5% of your money into US equities. You can allot around 5%. Now this can be done either through investing directly, which we have been discussing in this video, or it could be through investing in Indian mutual funds which invest in US equities. If you want to know a suitable fund for you, drop a comment. I will be happy to reply with some advice on one of the good funds which invest in US. To end this video, I would want you to take this simple test to find whether you are fit to invest in US securities directly. Just ask these simple questions to yourself. The answer is a yes or a no. Are you comfortable in finding a good stock to invest in the Indian markets? Do you have a good understanding of the dynamics of US economy and US politics? Do you have the courage to see your investment losing over 30% of its value in a single day? Do you have a good understanding of the dollar-rupee currency movement in the near future? If the answer to these 4 questions is yes, you should go ahead and definitely invest in US equities directly. If the answer to any of these 4 is no, resist the temptation. You still want to be in US. I have told you, you can select a good mutual fund which invests in US and still get the benefits. I hope you like the content of this video. Do like and share the video if you have liked it, and subscribe to my channel if you have not done it already. Thank you. Happy learning.